From here, possibilities are everywhere. From taking first steps here, to beginning your own wealth journey here. From backing global trade ambitions here, to delivering on that promise here. That's why we're here, in the world's most dynamic markets. A bank that connects potential to possibilities. So, where will you go from here?
Hi, everyone. Thanks for sticking around for our chat now. Thanks so much for being here, Marisa.
Pleasure.
I know we have a lot to cover, so we're just going to dive in. The financial sector has provided hundreds of billions of dollars of mitigation finance directed at the energy transition and technologies to reduce carbon emissions. Meanwhile, though, the adaptation finance gap is widening and now stands at between $194 billion and $366 billion per year, despite the fact that all nations will need to adapt to climate change. So with that in mind, I wanted to start there. Is it important that adaptation finance is understood to be just as critical as mitigation finance?
I think you said it right there when you said your gap is absolutely critical. So obviously we see the impacts proliferating all over the world, and this is a very, very real issue for people. Standard Chartered Bank, our footprint is largely in the developing world, so Asia, Africa, Middle East, where these effects are very serious for our populations. In many cases, the GDPs of these countries rely on the ability to adapt, and yet there's not enough capital flowing. And I think historically there was this belief in some respects that adaptation finance was in the purview of governments. It was the government's job, not the job for private sector. And I think we've got to reframe that narrative and make that as high on the agenda as mitigation.
Thinking about the narrative, as you just said, and knowing that we're at COP28 having this conversation, do you think COP28 needs to do more? Do you think more needs to be done here around this? And sort of also, why has this not happened before now? Why is this conversation just sort of starting now?
Yeah, I think given how serious this is, why? And it is the right question. First of all, I do applaud this COP for putting it on the agenda. It is a defined topic, and so it is definitely something that I'm seeing where I didn't see before. 2 COPs ago, adaptation felt like something people wanted to hide in a corner. And you ask, why is that? I've thought about that a little bit, and I have to credit Eric White of the World Economic Forum, who put it very nicely to say that by bringing adaptation into the private sector, it was almost an admission that we were failing, right? Because the whole point of mitigation was to try to avoid the effects of climate change that we're seeing now. And if you bring that onto the table, you're sort of saying we're not getting the job done. But I think we're all here recognizing that we're not getting the job done, so therefore it is really, really important. Just to maybe frame it from an economic point of view, because if you are going to get the private sector to participate, back to my comment about this belief that it was really the purview of government, to get the private sector engaged, we need to frame the narrative in a way that the financial services community and those who act in the finance world can understand that there is a return to be made, that there is a commercial proposition. Mm-hmm. And so we've done a bit of research and put a paper out called The Adaptation Economy, where we tried to express this in financial terms. And maybe one way to articulate this is in the concept of ROI. So our research found that effectively inaction comes at such a catastrophic cost, and that cost will increase exponentially at an exponential rate the higher the temperature rises or the longer we wait. So math terms would say that if we could just put about $30 billion a year into 12 emerging market economies, these are huge economies in the world, on whose services and goods we rely and we want to buy and have continue. If we just put $30 billion to work, we would save about $380 billion of loss in GDP degradation. So if you put those in classic finance terms, ROI, it's about a 12 times ROI on that investment. Pretty darn good investment relative to many financial instruments, even in a high interest rate environment. So this is what we're trying to get out there and help people understand the opportunity set as much as it is the risk side.
And I can imagine that type of white paper really does set the precedent, or the sort of the urgency around why now, and brings attention to the question of why is it taking so long. So that's wonderful to see.
Math does get pretty ugly as the longer you wait, for sure.
So moving on to the E&S of ESG a little bit, adapting to climate change through investment in resilient infrastructure, secure water resources, protecting coastlines, and other measures do pay triple dividend. That's a little bit of what you were just talking about there. Do opportunities deliver social benefits alongside environmental benefits? And how do they really make adaptation finance more appealing to organizations?
Well, at the heart of all this is people. I mean, it is about people, because climate change, this intersection that, again, I think is much more in the lexicon, is a people issue. We're talking about humanity, but we're talking about real lives. So when I say our markets are deeply, deeply affected, when I talk about the economies that we operate in, a big proportion of the GDP and people's livelihoods might be agriculture or might be fishing. And all of those are at peril, and if we don't have capital flowing to help them to adapt to these realities, and especially, if we keep on the same trajectory, it gets worse and worse, these people will not have jobs. And if the governments in those countries do not have enough capital, which they don't, then we're facing massive disruption, as I say, in our supply chain. So if you want to be self-interested, if you're sitting in the West and you want these goods and services, or if from an emotional and humanitarian side, these economies, the people will have to move. And it really strikes home for me when I go in some of these forums and you will go to a pavilion of an island nation who's underwater and you hear them say things like, my country will be unlivable for my children unless we do something fast. I mean, that's hard to hear. And it's not about only loss and damage. And of course, that's an important topic that's been on the table of COP, but it is actually how do we recognize that with this urgency and this imperative comes a commercial opportunity for that private sector to play. And this is where I think for the investment community, we can also create a nice combination or a nice intersection, or if you want to say a multiplier effect of the E and S, because I do think the E has drowned out, the environmental side has drowned out a bit the S, but very many investors who have that as part of their portfolio and ESG strategy, you can neatly put those two things together in a very complementary way.
Right, right. And do you think this will help scale up investment towards adaptation?
Well, I am hopeful. So as much as that all sounds like a bad news story, we did a poll of those who allocate very, very large pools of capital. So the negative side of that is that we asked these investment managers and portfolio managers and institutional funds how much of your capital today is allocated to the topic of adaptation. First of all, a lot of those people came back and said, what are you talking about? What's adaptation? So we start there with definitions and what do we mean by adaptation. But those who actually kind of understood what we were talking about basically told us it was very, very little. So that's sort of the outside of the conversation. It was some tiny fraction of their capital pools were headed toward this area. The good news story is that because of putting it on the table at COP and because of good works of many of those who are partnering with to get this on the table and get it defined, 75% of those big pool capital allocators have said that they will migrate more money to this topic in the coming year or years. So that leaves me, I guess, quite hopeful that it's well recognized in the commercial, private, for-profit return sector, not just the government sphere.
Wonderful. And as you mentioned, if we can migrate that capital, economies can be more resilient, which is obviously wonderful to see amidst the changing climate. And kind of thinking about Standard Chartered a little bit in this conversation, sure. What does this mean in practice for a bank like Standard Chartered, especially when thinking about the markets you're in? You mentioned this a little bit before, but Africa, Asia, and the Middle East, where obviously the impacts of climate change are really significant. Mm-hmm.
So as we are a bank that uses our balance sheet to provide lending capital or underwriting capital to our clients in our markets, so a lot of this starts, we are a regulated entity, and our regulators now are very clear. They're asking us to take a whole, hard, deep forensic look at our loan book and understand where that loan book is exposed to climate risk. So therefore, in order for us to do that, we are working quite actively with all of our clients to whom we lend. And we have a whole methodology for how we do that. And as we're going through this exercise with our clients, we can see those very specific areas where they're exposed. So what does that do? That leads us to a place where we can go and engage with our clients on the places where there are hot spots, and we can work with them to say, okay, now how do we work with you so that we can address your risks and make you a better credit for us? So that creates that ability for us to continue to provide capital to them. And if we have our clients then respond to that, it makes it a very easy conversation because they're much better credit risks, and we will want to favor allocating capital to where it is well protected. But also, the more we're getting into this, and we're being very deliberate about this, and I can maybe share with you in the audience, to those of you who are in the capital allocation or financial services arena, what we are trying to do, and I believe this deeply, I've been a capital markets and investment banker in the traditional sense for my whole career. And when I have helped to try to build asset classes, the way you can mobilize capital at scale is when you have a common definition. So back to let's start with the definitions, and a common adopted set of practices, and a belief where you can follow best practice use cases. So we took that as a concept and said, if we're going to try to mobilize this capital in a big way, let's try to start with that definition. Let's crowd in those peers and other partners that can help us define what this might mean to them. So an insurance company might look at this slightly different than a bank versus a private equity fund. But let's come to some sort of common agreement. We'll create a framework, and we've been doing this very actively with wonderful partners like the UN, like the World Economic Forum, and other banks and consulting companies to create a framework for adaptation. Now, I do want to be clear for those who've been at this for a really long time, because there are lots and lots of adaptation frameworks, but most of them were born out of perhaps the humanitarian aid or disaster relief arena, which was either the private sector or the philanthropic sector. We needed to kind of create this framework and bring the good work all together under one umbrella that speaks to the private sector actors. So we've been hard at work doing that, but then beyond that, we're creating a practitioner's guide. So if you are a bank or a financial institution, where can you actually lend or allocate capital into something within the sphere of adaptation that is commercially viable? So whether that is resilient infrastructure. You know, I say things, simple things, and sometimes it just doesn't, until you put it in these terms, people don't, in the private sector, don't think about it this way. This isn't just throwing good money after bad in a challenged place. It is, if you're saying I'm going to finance the new model of the built environment, aren't those the products that people are going to want to buy? You know, the homes that people are going to want to buy are the ones that can withstand storm activity and sea level rise and extreme heat. If we want to have those goods and services be in our trade finance flows, aren't we going to want to finance new models of agriculture and plant species and all the wonderful tech that you're so well promoting, that with precision farming, with crops that can withstand water shortages and so on? I want to finance those. Those make perfect sense. Those are the goods and services people want to buy. Commercial opportunity. So what we're doing is we're going category by category in this framework and saying, here's where you could play, depending on who you are, if you're insurance or a bank or whatever. And then maybe we all come together and get this moving in the kind of scaled way that we have been for mitigation.
Wonderful. It's great to hear all about that actionability that you're raising to the topic with that framework. I know we are over time, so thank you again, Marisa, for your time today. I know. All right. For all that great insight. Thank you so much.
Well, thank you. We look to engage.